True profitability in trading is rarely found in the places beginners look. It is a common misconception that success is achieved by discovering a secret chart pattern or mastering an esoteric indicator. Many novice traders spend years chasing the illusion of a perfect predictive system that simply does not exist. We must shift our focus from these external factors to the internal and statistical realities of the market. The real transformation into a profitable trader is marked by three profound shifts that govern psychology, statistics, and execution. These shifts separate the speculator who gambles from the professional who manages risk. Today, we will explore these three non-negotiable signs that indicate you have finally crossed the threshold into consistent capital growth. We will examine the mental game, the mathematical edge, and the methodological mastery required to sustain success in any market cycle. The first fundamental sign of professional competence is the decisive shift from prediction to probabilistic thinking. The novice trader is constantly seeking validation, desperately trying to predict the exact high or low of the next market swing. They feel an intense internal pressure to be right on every single trade they execute, which clouds their judgment. This need for certain prediction is the single greatest impediment to achieving long-term profitability in the volatile financial markets. Successful trading is not about knowing what the market will do next. It is about knowing what your statistical edge will do over a large series of trades. The profitable mindset accepts, without reservation, that the outcome of any individual trade is entirely random and unknowable. A perfectly executed setup might result in a loss, and a poorly executed setup might result in a substantial gain. This randomness must be embraced as the fundamental nature of the market, not fought against through emotional resistance. The professional focuses intensely on the consistency of their predetermined methodology across an entire series of trades, rather than scrutinizing the result of the last closed position. They understand that their job is simply to execute their edge flawlessly whenever the proper conditions present themselves. This deep detail requires embracing what is often called the next 10 trades concept, a framework popularized by seminal trading psychologists. Under this concept, the trader treats every new setup as just one event in a statistical sequence of 10 or 100 possibilities. The emotional weight placed on trade number 1 is identical to the weight placed on trade number 100, which is to say, almost none at all. The goal is flawless execution of the established edge, knowing that the positive results will only materialize through repetition and volume. When this shift occurs, losses are no longer viewed as personal failures or errors in judgment. Instead, losses are simply accepted as the predetermined, necessary cost of doing business within a probabilistic model. They are the statistical price paid for accessing the positive expectancy inherent in the chosen trading strategy. This acceptance removes the destructive cycle of revenge trading and emotional chasing that plagues most amateur participants in the market. The trader's internal monologue changes from, "I must recoup that loss," to "I must execute the next valid setup regardless of the previous outcome." Evidence of this profound psychological shift is visible in the trader's emotional stability during large market swings. When a profitable trader enters a position, they feel less emotional volatility because they have already accepted the maximum possible loss. They trust their stop-loss placement implicitly, knowing it represents their calculated risk exposure for that specific statistical event. The market's gyrations between entry and exit become merely noise, background movements that do not trigger fear or greed. This detached perspective allows the professional to hold a winning position through normal market retracements that would typically frighten a novice out of the trade too early. The novice, seeking certainty, panics when the price moves against them even momentarily, fearing the loss of paper profit. The professional, relying on probabilities and methodology, trusts the stop-loss and the target, allowing the underlying market structure to dictate the holding time. This ability to sit with a profitable trade is a core component of maximizing the mathematical edge, which is the second critical sign of profitability. The acceptance of randomness also manifests in the ability to walk away when no valid setups exist. Novices often feel compelled to trade because they believe they must constantly interact with the market to make money. The profitable trader recognizes that their edge only exists under specific, predefined conditions that may occur infrequently. They are perfectly content to sit on their hands, conserving capital and energy until the statistical advantage is clearly present. This disciplined patience is a direct result of understanding that forcing a trade where the probability is neutral or negative is statistically destructive. Every trade taken outside the rules dilutes the overall positive expectancy of the system. Therefore, the trader's primary directive is capital preservation through strict adherence to high probability entry criteria. They view non-trading periods as successful management of their risk capital rather than missed opportunities for profit. Consider the daily routine of a truly profitable trader. It is often boring and repetitive, not exciting or high stakes. They are executing the same checklist, looking for the same patterns, and managing risk with the same strict parameters every single day. The excitement has been replaced by the quiet confidence that comes from statistical certainty over time. The emotional highs and lows that define the amateur experience have been smoothed out by the acceptance of the probabilistic nature of the endeavor. The profitable trader understands that the mental anguish associated with a loss stems only from the belief that the loss should not have occurred. By accepting the inevitability of losses within any system, regardless of its quality, the psychological battle dissipates entirely. This shift creates a mental fortress where market movements are interpreted logically, not personally. It is the necessary foundation upon which all sustained success must be built, ensuring that emotional errors do not compromise the statistical edge. Furthermore, the professional trader's definition of a good trade is entirely divorced from the financial outcome. A good trade is one that was executed flawlessly according to the written plan, regardless of whether it was a winner or a loser. A bad trade is one where the rules were violated even if it resulted in a monetary profit, because it introduced damaging behavioral uncertainty into the system. This dedication to process over result is the ultimate proof of the probabilistic mindset. They recognize that a profitable outcome from a rule-breaking trade teaches the wrong lesson and encourages future statistically disastrous deviations. By prioritizing methodological adherence above all else, the trader reinforces the habits necessary for long-term consistency. This focus on flawless execution is the mechanism that translates a theoretical statistical edge into actual capital growth in the trading account. The mental game is mastered when process execution becomes the sole metric of success. The second crucial sign that you're becoming a professional is establishing positive expectancy, which is the undeniable mathematical edge. Expectancy is formally defined as the average return a trader can expect per dollar risked over a large sample size of trades. It is the statistical heart of any profitable system, quantifying the system's ability to generate net profit over time. Without a measurable positive expectancy, any trading activity is simply a form of gambling masquerading as investment. The critical calculation that the profitable trader knows intimately is that their average winning trade size must significantly outweigh their average losing trade size. This relationship must hold true regardless of their overall win rate percentage. Many beginners mistakenly believe a high win rate, perhaps 70 or 80%, is the necessary component of success. However, a high win rate is meaningless if the average loss is 3 times the size of the average win. Consider a specific fact example drawn from a meticulous trading journal. A trader might maintain a modest 40% win rate, meaning they lose 6 trades for every 4 they win. If, however, they consistently apply a strict 2-to-1 reward-to-risk ratio, their average win size is twice their average loss size. This statistical arrangement ensures positive expectancy, meaning that even with more losing trades than winning trades, the total capital growth curve remains firmly positive. The profitable trader therefore stops focusing obsessively on the percentage of wins in isolation. Instead, their attention is solely fixed on the total capital growth curve and the maintenance of their critical reward-to-risk ratio. They understand that a 40% win rate can be highly lucrative and sustainable if the average win size is large enough to absorb the necessary string of losses. The focus shifts from being right often to making sure the few times they are right pay handsomely. This mastery of the mathematical edge requires rigorous adherence to risk management principles, specifically regarding capital exposure. The professional never allows a small, manageable loss to violate the predetermined risk percentage set for the entire portfolio. This means risking no more than 1% or at the very maximum 2% of total trading capital on any single trade setup. This strict limitation ensures that a series of inevitable losses does not materially damage the account. If a trader risks 10% of their capital per trade, they only need 10 consecutive losses, an easily achievable event in volatile markets, to wipe out their entire account. By contrast, a trader risking 1% per trade would need 100 consecutive losses to suffer the same fate. The professional understands that longevity in the market is achieved through the meticulous preservation of capital, not through aggressive high-stakes bets. Risk management is the mathematical insurance policy that guarantees survival long enough for the edge to play out. The calculation of expectancy is simple yet profound. Average win, win rate, average loss, loss rate. If this result is positive, the system is profitable over the long run, and the trader's job is simply to execute it repeatedly. If the result is negative, no amount of psychological strength or market insight will save the account from eventual depletion. The profitable trader constantly audits their journal to ensure this core mathematical truth remains intact. They analyze their trade history not to mourn past mistakes, but to identify any creeping erosion of their average reward-to-risk ratio. If the average win size starts shrinking relative to the average loss size, it is a clear warning sign that the entry or exit criteria are degrading. This statistical feedback loop allows for precise, unemotional adjustments to the trading plan. The market dictates the rules, and the statistics confirm the efficacy of those rules. The application of a robust reward-to-risk ratio also fundamentally changes the psychology of the stop-loss. The stop-loss is no longer viewed as a painful necessity, but as the precise definition of the risk unit, R. When a trade is entered, the potential profit target, 2R or 3R, is established relative to that precisely defined risk unit, 1R. This framing transforms trading into a manageable, scalable, and quantifiable business endeavor. Furthermore, positive expectancy demands that the trader be extremely disciplined about cutting losses short. Allowing a loss to run beyond the predetermined stop-loss violates the mathematical premise of the entire system. If the maximum loss is supposed to be $100, 1R, allowing it to grow to $200, 2R, effectively halves the system's overall expectancy instantaneously. The professional views the stop-loss as sacred and executes it mechanically the moment the price crosses the threshold. This rigorous statistical approach extends into portfolio management, ensuring that capital is allocated efficiently across multiple potential opportunities. The profitable trader may have multiple strategies running simultaneously, but each one must demonstrate its own independently positive expectancy. They do not rely on one single setup or one single market to generate all their returns, diversifying their statistical edge across different environments. This diversification reduces the impact of any single market anomaly on the overall health of the trading business. The commitment to positive expectancy means the trader treats their journal like a business ledger, where every entry is a transaction that contributes to the overall statistical outcome. They are not chasing quick wins or relying on luck. They are meticulously managing probabilities. This mathematical rigor is the second non-negotiable pillar supporting sustained professional profitability in the financial markets. The amateur trades hunches. The professional trades proven statistical advantage. The third and final sign that a trader has achieved profitability is methodological mastery and flawless execution of a defined system. The profitable trader does not rely on vague feelings or generalized market sentiment. They operate using a clearly defined methodology based on observable market structure. This structure often involves recognizing the underlying phases of institutional activity, such as accumulation or distribution, concepts deeply rooted in the work of Wyckoff. Methodological mastery means the trader can identify precisely when the major interests are absorbing supply during an accumulation phase. They know the signs of strength, such as a selling climax followed by an automatic rally, and they wait patiently for the spring or the test of the supply before committing capital. Conversely, they recognize the signs of weakness during distribution, identifying where the large players are offloading their positions. This structural knowledge provides the necessary context for high probability entries. The defining characteristic of this mastery is the discipline of non-deviation. The sign of professional execution is the ability to execute the trade only when all, without exception, rules of the system are met. This requires immense emotional control, especially when the market looks highly tempting but has not yet triggered all the necessary criteria. The profitable trader avoids the common trap of fear of missing out entries that plague those without a strict methodology. If the system requires 3 specific conditions, say, a test of support, high volume confirmation, and a specific candlestick closure, the trader waits until all 3 are present. They understand that compromising even one rule degrades the statistical edge, violating the positive expectancy established in the second sign. The methodology acts as an objective filter, eliminating subjective judgment and emotional bias from the decision-making process. Evidence of this methodological mastery is found in the maintenance of a detailed trading journal that records far more than just profit and loss. This journal records the precise reason for the entry and exit, mapping the trade back to the written rules of the plan. It serves as an audit tool, proving that execution aligns 95% or more with the established written trading plan. Any deviation is logged, analyzed, and treated as an execution error regardless of the trade outcome. This rigorous auditing ensures that the trader is holding themselves accountable to the process, not just the result. If a trade was profitable but violated rule number 2, the journal must record the violation and the potential long-term damage caused by the behavioral lapse. The journal becomes the objective mirror reflecting the trader's discipline and consistency. It is the final arbiter of whether the trader is operating as a professional or an amateur. Historical observation from experienced traders such as Jesse Livermore echoes this crucial discipline. Livermore noted that the big money in the market is made not by constant thinking or frantic trading, but by the discipline of sitting through the move once the position is established correctly. Once the market structure confirms the entry, the profitable trader must have the conviction to let the statistical edge unfold without interference. Premature profit-taking is just as destructive to positive expectancy as allowing a loss to run too far. The ability to sit requires absolute trust in the structural analysis and the predetermined profit target, the 2R or 3R level. The novice often takes profit at the first sign of opposition, leaving the majority of the potential gain on the table, thereby destroying the necessary reward-to-risk ratio. The professional knows that once the position is established based on sound methodology, their only remaining job is to manage the risk and allow the trade to achieve its full potential. They only exit if the predetermined market structure is decisively invalidated. Furthermore, methodological mastery dictates the immediate mechanical cutting of losses when the market structure is invalidated. If the trader entered based on the belief that a specific support level would hold during accumulation, and that level is subsequently broken and traded below convincingly, the thesis is destroyed. The professional exits immediately, regardless of the monetary loss, because the structural reason for the trade no longer exists. They do not wait for hope or a minor reversal. This adherence to structural invalidation is the hallmark of risk control integrated with methodology. The entry is based on opportunity, and the exit, whether profitable or losing, is based on structural confirmation or structural invalidation. There is no room for subjective interpretation once the price action definitively breaks the established boundaries of the trading setup. This mechanical response protects capital and maintains the integrity of the overall statistical system. The profitable trader's methodology is not static. It is constantly refined based on the statistical feedback from the journal. However, the core principles of market structure and institutional behavior remain constant. They are always seeking to trade alongside the major interests, recognizing that price moves significantly only when institutional capital is fully committed. Their system is designed to identify and exploit these footprints of large-scale participation. For instance, understanding the Wyckoff concept of a spring during accumulation allows the trader to enter at a point of maximum statistical advantage. The spring represents the final shakeout of weak hands before the institutional markup begins. Waiting for this specific structural event and executing only at that point epitomizes methodological mastery and ensures the highest probability of success. It is the commitment to this precision that defines the professional. We have explored the three non-negotiable signs that signal a trader's transition to sustained profitability. First, the psychological shift to a probabilistic mindset, where the outcome of single trades is accepted as random and focus is placed entirely on process execution. Second, the establishment of a robust positive expectancy, where the mathematical edge is secured by maintaining a high reward-to-risk ratio and strict capital risk limits. Third, the achievement of methodological mastery, ensuring flawless execution of a defined system based on observable market structure, such as identifying phases of accumulation or distribution. Profitability is not a sudden destination achieved by finding a secret indicator or magical formula that predicts the future. It is instead a continuous process driven by professional habits, statistical rigor, and unwavering discipline in execution. The successful trader is essentially a manager of probabilities and risks, not a predictor of price. They treat trading as a serious business, applying objective rules and auditing their performance against those rules rigorously. We strongly encourage you to audit your current trading habits against these three core standards of professional performance. Review your journal. Are your losses capped at 1R, and are your wins averaging 2R or more? Examine your psychology. Do you feel detached when you take a loss, or does it trigger emotional resistance? Analyze your execution. Did your last 10 trades adhere 100% to your written trading plan? Honest answers to these questions will reveal exactly where you stand on the path to consistent success. If the concepts of market structure, institutional intentions, and disciplined execution resonate with you, and you seek a foundational framework for developing your own methodology, then there are classic resources available. Understanding the true mechanics of how large operators move the market is the key to mastering methodological execution, particularly through the lens of supply and demand dynamics. We want to draw your attention to a resource that distills decades of market wisdom into actionable principles. The timeless principles of market analysis and trading strategy are often best found in the original works of the masters who defined this industry. Learning to read the market's behavior, identifying phases of selling climax, identifying the automatic rally, and recognizing the signs of strength is essential for the third sign of mastery. This deep understanding is precisely what is offered in the adapted edition of How I Trade and Invest in Stocks and Bonds. This essential text provides a clear, proven pathway to analyzing the market, enabling you to determine the intentions of the large players before significant moves occur. It helps you build the foundational knowledge required to implement a robust, rules-based system, securing your positive expectancy. Stop guessing the market's next move and start trading based on time-tested methods for identifying institutional footprints and making informed trading decisions. You can begin building your professional framework today by accessing How I Trade and Invest in Stocks and Bonds. The link is available directly in the description below. The path to professional trading is challenging, but it is clear and defined by these three pillars: psychological detachment, mathematical advantage, and systematic execution. Embrace the process, trust your statistics, and maintain relentless discipline. Your success is determined not by market luck, but by the quality and consistency of your daily habits.